Good day, students. This is part 2 of the valuation video. So in the previous video, we had actually computed our income statement together with our balance sheet. If you were to remember at the end of the video, all I had detailed was your overdraft facility, using that as sort of the balancing figure in your balance sheet and getting the plug number for that. And then your income statement interest expense would then flow through from that overdraft at 12%. Now what we're trying to do in the questions that they've asked is to estimate firstly the amount of financing we need, which we've done in terms of the overdraft. But now what we're trying to do is also come up with a valuation of this entire business, assuming it reaches the 22 stores. Now that we're going to be doing a valuation, we will be using the income statement together with the balance sheet to calculate what we need in terms of your cash flows for the capital budget. Before I go through the capital budget in detail, what I'd like to explain is a concept called terminal value. So I'm going to just project this on the slides. For the capital budgets that we've done up until this point, and the ones we've covered in the examples, they actually end at a point in time where you've got your end of project cash flows, where you sell off your assets and you sell off anything that you need to pay or that you need to do to close off your project, and you pay the related tax to that and you recover your working capital. But if you are valuing a business, or you're valuing a project that's going to happen in perpetuity, which means it's going to happen for a very long time going forward, that you actually need to get what is called a terminal value. The terminal value represents the cash flows going forward in perpetuity at a point in time with a certain growth rate. So if you're valuing a normal business, maybe you might come up with a growth rate for the next 5 years for your cash flows. And after year 5, it starts to stabilize and get maybe a growth rate of 2% per year going forward in perpetuity. What the terminal value is trying to do is calculate what that entire value is once it gets to that stable stage of growth, and try and actually get that amount that you need to then present value. How do we calculate your terminal value? The terminal value formula is your end of period cash flow. You're going to grow that by what they've given you as the free cash flow. This FCF stands for free cash flow growth rate. Okay. And then you're going to take your discount rate or your WACC less your free cash flow growth. That will then represent the terminal value that you then need to add to your present value to reflect all those cash flows that happen after your project has reached the stable stage, or all those cash flows that happen after your company has also continued to operate, but it's reached that stable stage of growth. Okay, so we're going to also, in this example, because remember, these cafes, they haven't decided to go and close shop and close all the 22 cafes that they have in operations. What they tell you in the question, if we were to go back now to the question, is we need to make an assumption here that there's a growth rate after these few years of 3%. Okay. So now that the company reaches, you calculate the revenue, they get profits up until 2022. From 2023 onwards, this company is now going to grow its free cash flow at a rate of 3%. Okay. They've also provided you here with the discount rate of 25%. Another name for your discount rate would be your weighted average cost of capital. And now they're asking you to calculate the NPV of this revolutionary endeavor. Okay, so we've already done our income statement with all 22 cafes up until 2022. And now what we're required to do is calculate our net present value. From years 2023 and onwards, we need to calculate what is called a terminal value because they're going to continue to grow at a stable rate of 3% going forward, assuming we don't go and close all these cafe shops. Okay, let's have a look at how we calculate then our free cash flow using your income statement. If you look at the income statement, you'll remember that the income statement contains items that relate to non-cash items. So if you were to go back to your income statement here and look at what is included here in your calculation under your profit before interest and tax, you're including a depreciation calculation. For the free cash flow purposes and for the capital budgeting, you do not need to include the depreciation as it is non-cash. So you'll notice what we're going to try and do here. What we're going to do is bring in this profit before interest and tax. So all these line items here, and add back the depreciation as we want to remove it and show that it hasn't happened because it's a non-cash item. Had you not had depreciation, for instance, in this period, you wouldn't have had to subtract 800,000 from all these calculations. Okay, so what you would have had in 2018 profits, had you not had to subtract that 800,000 depreciation, you would have made a profit of 760,000 or cash of 760,000. So you'll notice here what we do first is we bring in firstly your profit before interest and tax, and you calculated net of tax. You want to remove the tax effect. Okay, the reason why we bring it in profit before interest and tax is if you also remember your financing component, which is your interest expense, you want to exclude your interest expense and you want to include the tax impact of that interest expense, because this will be included in your discount rate, which is the discount rate you've been provided here of 25%. I want to exclude the non-cash items, which is the depreciation. And then I also want to exclude the interest expense and the tax thereof, because that is included in my discount rate. Okay, so how you set this up when you're doing your income statement is you bring in what is called your profit before interest and tax. Okay, this is before the interest calculation and before your tax calculation, but then you go and remove the tax impact of that. And what you then see here is just your profit before interest and tax at each point here. And then you subtract what the tax impact would be. So I'm just going to update this calculation for you. Just going to drag it across. Okay, each time I take the profit before interest and tax, 1 minus your tax rate. Then I add back the depreciation, because I said to you guys the depreciation is non-cash. Okay, then each time you just take from your income statement the depreciation that you had subtracted, you add it back here to reflect the depreciation. What you haven't done in your capital budget is also taken into account your working capital. As you remember, your capital budget needs to include the change in working capital at each year that happens in order to bring that into your capital budget. Okay, let's now calculate our net working capital. How we calculate this net working capital here, this will be our inventory balance plus your accounts receivable less your accounts payable. Okay, so your working capital is made up of 3 accounts. Your 3 accounts that you're bringing in are your inventory and your debtors. You add up those 2, and you then need to subtract your creditors. I've called it here accounts receivable or accounts payable. In our example here, we could also call it plus your debtors less your creditors. Doesn't matter what you call it. So if you notice my calculation here, I'm adding the 2 assets, the debtors and the inventory, and then I just subtract your creditors of 369,863. I do that for every single year. I add up the 2 debtors and inventory balance, and I subtract each time your creditors balance. Do it for all the different years. You'll notice that your net working capital is 54795 in 2017, but in 2018 going forwards, if you were to add up your debtors and your inventory and less your creditors balance, you get to a net working capital of 0. Okay, so you'll remember the amount that you need to then include in your free cash flow is the change in that working capital. And if we were to look at the change in capital going from 54795 to 0, you've actually had in that year a 54795 impact. And in all other years, because it's moving from 0 to 0, you actually have no working capital that you need to take into account. Okay, so we needed to invest in this working capital of 54795 in that year. But then going forward, we don't need to continue to plow in additional money into this working capital because your balance is just 0. Your debtors and your inventory balance together equal your creditors balance. If you notice here in the cash flow statement, they're doing the exact same thing, except they're doing the current assets together and separating out the current liabilities. But if you add these 2 balances together, either way, it's a balance of 0 each time. And we've calculated here as our change in working capital, it's a balance of 0 each time. Okay, so now for our cash flow, what we've done is we've brought in our profits for the period. We've also then brought in our change in working capital for that period. And last but not least, we need to bring in anything that we've spent our money on in terms of acquiring any assets. And if you'll remember correctly, we had spent 900,000 for 3 stores every single year to actually bring those store count up to 2020, to 22 stores in 2022. Okay. So if we've spent 900,000 for each of the 3 stores in each year, from 2018, 19, 20, 21, 22, we need to also note that there's a cash outflow going out of the business of 2,700 each period. Okay. There's 3 stores, 6 stores, 9 stores, and 12 stores. And if you remember correctly, 2022, we didn't have to get any new stores. At that point, we're sitting at 22 stores already. Okay, so my cash flow includes my profits that I've brought in. I need to remember to exclude depreciation and also exclude the interest. And then I need to bring in my working capital from my balance sheet and any new assets that I've purchased. And it's the cash items of those assets. Do not go and look at any depreciation calculations. The amount you've spent on these assets is your full 900,000 that you're spending every single year to go and open these new cafes. How depreciation has been taken into account is in your profit before interest and tax. When you've minus there this 21 minus the 28%, you've taken into consideration the fact that your tax payment allows you to reduce depreciation there. And that is why we're adding back the depreciation separately. So how we've taken depreciation into account is only in the tax payment because we get that deduction from SARS. But depreciation itself should not feature, and that is why we're adding it back and forth. Okay, if I add all those changes, which is your profits, together with your working capital, and lastly, what you've paid for all those 3 cafes each year, your free cash flow will be just the addition of all 3 accounts, which will be 1912, 1983 negative, 13878 negative. And then we only start making profits. If you look at free cash flow, we only start getting free cash flow coming in from 2022 onwards. But don't forget, yes, we've spent a lot of money from 2018 to 2021, but from 2023 onwards, you need to remember that there's that terminal value. So now that the stores are going to go at 3% in perpetuity going forward for life, we need to still bring in that huge terminal value, which is the growth of those stores going forward forever. Okay, so now what we're going to do is if we use midpoint discounting, we're starting off in 2018, we're going to use 0.5, 1.5, 2.5, 3.5, 4.5, and then I'm going to PV each of these. If you remember how I showed you how to do a present value calculation, you use the Excel formula, the PV formula, you bring in the rate of 25%, which is the rate they've told you here in the question. You bring in the time period, which is 0.5. We're using midpoint discounting. So we're assuming that these cafes are earning money throughout the year and not at the end of the period. Your payment is 0. And then all I'm doing is bringing in this future value here and trying to present value it by 0.5. Okay. Each time I do the exact same thing per year, except I just bring in the new period and the new free cash flow relating to 2019. And this should be the present value you're getting for each of the years. Okay, the only thing I'm then left to do is then calculate that terminal value. I'm going to put the formula here on the left to just show you as a reminder what that calculation is. Okay, what is this calculation for this terminal value that I need to bring into account here in my Excel? Okay, so from the end of period cash flow, I've managed to make 4 million. And now I want to grow this 4 million. Okay, so I take that 4 million. I then use that formula that I've then used here on the left, which is 1 plus your free cash flow growth divided by your discount rate or your WACC minus your free cash flow growth. You use just this exact formula and plug it in. Your free cash flow growth rate that was provided in the question, if you looked carefully, was 3%. And the discount rate you've been provided was 25%. So you basically are saying the 4 million times 1 plus 3% divided by 25% less the 3%. Okay, it's pulling these figures down here. If you notice, free cash flow less discount rate, less the free cash flow rate. All it is it's pulling these figures from here, the 3% and the 25%, which I've already said is what is in the question here on the left. Okay, we get to a terminal value, which is the huge value that's going forward, of around 18 million rand. So yes, from 2018 to 2021, we're making losses. We start making cash flows from 2022, but then we've got this huge terminal value that starts to kick in from all those other years in perpetuity, and I need to bring that into my calculation. That terminal value represents the value as at 2022 that then needs to be present valued. Remember, it's not the value as at 2023. People get this wrong. This terminal value, once you've done the calculation, it represents the value as at 2021. Just 1 second. I want to do the full screen. It represents the value as at 2022. So we also need to discount this not at 5.5, but at the 4.5, the same rate we're discounting at the 2022 rate. Okay, so let's start to do that. I need to present value that one using the discount rate of 25%, 4.5 years, bring in that amount here. And then lastly, I'm bringing in my terminal value also at the 4.5, because it represents this terminal value at that point. And then you're bringing in that 18 million and trying to PV that back. Okay, now what you can then do is combine all your PVs, okay, excluding that terminal value, and then include the terminal value. This entire venture, if I add the two, is worth 5 million, so 4.989. Okay, that represents then my enterprise value, what the firm value is worth. You'll notice that this excludes the current cash that you've got at the end of 2017. How much cash are we sitting with? If I go back, I'm sitting with cash, a cash facility of around 80,000. I need to bring that in. This business, if I add the net cash and the enterprise value, all the cash that's going to be coming from the business going forward, together with the cash that's currently sitting in the business, I get to a business value of 5 million rand, 5,069. Okay, what is 20% of that? 20% of that is 1 million rand. If you actually have read the question here at the end, what it was asking you and the reason why they've calculated this 20%, a VC offers you 1 million for a 20% stake. Discuss the merits of the offer. Okay, the VCs offered me 1 million, but from what I've calculated here on my value of the 20%, the value is around 1,013,865. Okay, the question is, do you think this is a value, a good offer? Depending on how the market is actually reacting. If it's a market where not a lot of transactions are happening, the VC actually wants to try and sort of get into this business. And so they'll try and undercut you. Okay. Or sometimes what needs to happen is that the VC needs to, if it's a very good market and this business is sought after by a lot of different VCs, they then need to offer you a premium to that 1,013. So you can then say, listen, as a minimum, I at least need 1,035,000, 1,050,000. So you then need to discuss what you think the merits of the offer is. But besides the merits of the offer, what we're trying to show you is how to calculate that enterprise value, how to use then the capital budgeting in a real world example. Okay, so you've got your income statement and your balance sheet, which I've summarized. From the income statement and balance sheet, I want to take into account my profit before interest and tax. I want to exclude depreciation. I want to exclude interest from that calculation. Why do I need my balance sheet then? My balance sheet will give me an indication of, remember, the working capital. So if you've spent on inventory plus your debtors less your creditors, each time that moves, the movement, you're spending more and more money, you need to bring in that change in working capital also in your cash flows and your capital budgeting. And then last but not least, if you spend on acquiring any new assets, the amount you're spending on acquiring those assets, for our example, we've spent 900,000 per cafe. So in 1 year, we're spending on 3 cafes, 2.7 million. We need to bring in that 2.7 million. And then we get to the free cash flow. Once you've gotten to the free cash flow, you can start present valuing that back. The most important concept that you needed to get from the Chez Guevarra case is firstly how to use the income statement to then get to your cash flows. But besides using your income statement, it's the next important concept is how to actually get to that terminal value. Okay, all you have to do with the terminal value, be sure to actually just jot down this formula and be aware of this formula. And just know that it's your end of cash flow. So it's always just before the end of your cash flow. What is the last cash flow you ended at, which was the 4 million? You grow that at 1 plus the free cash flow growth rate, and then you take the discount rate less the free cash. You use this exact formula to calculate the terminal value. Then the trick with this terminal value, once again, is it does not represent 2023 terminal value. It represents the one at 2022. So we're going to discount the 22 years together with that terminal value and get to what we think the enterprise value is worth. Okay, I'm going to provide also this Excel spreadsheet just so that you can also go through it and go through my examples. And if you guys have any questions, I'm happy to answer those. But this should be a detailed way of doing a full company valuation. You use your income statement and balance sheet. You look at forecasts going forward. You bring into account the cash relating to those forecasts and try and present value those and get to what you think the value of the firm is worth, or the venture that you're doing is worth. All right, guys. I hope you guys understood and enjoyed the session. We'll catch up soon. I'm happy to also answer any questions once again. Thank you.